Welcome to the Deep Dive. For you listening, we have a really fascinating, honestly kind of crazy mission today. We are looking at this incredibly high-stakes standoff happening right now in the crypto world.
Oh, yeah. It is definitely a standoff.
Right. I mean, we're talking about over $1 million, real, hard cash, sitting on a digital table on this platform called Polymarket. And these whales, these algorithms, they are essentially flipping $1 million coin on whether Ethereum is going to crash down to a $1,500 price floor by the end of 2026.
Which is just wild to think about, considering the sheer volume of money locked up in this one specific outcome.
Exactly. It's not just like people arguing on Reddit. This is real money. And to me, looking at it, it feels like a massive financial tug of war where both sides are just perfectly immovably matched in strength. I have to ask, how rare is it to see a prediction market with this much volume just completely deadlocked like this?
It's honestly incredibly rare. I mean, usually capital markets, especially in crypto, right? They're highly directional, they move fast.
Like they jump on a trend?
Exactly. Capital aggressively seeks the path of least resistance whenever new info drops. But on this specific Polymarket contract, the odds are sitting at like exactly 48.5% for the yes side.
Basically a literal coin flip.
Literally. It represents one of the most evenly split markets in all of crypto prediction right now.
Which kind of makes me question this whole idea of, the wisdom of crowds. Like, if we have $1 million split so evenly down the middle, does that mean the market is just incredibly efficient and perfectly balanced? Or does it just prove that the collective crypto space is entirely confused about the future?
Well, I'd actually lean toward it being efficient, surprisingly. I mean, neither side is operating on, irrational hype or panic here.
Okay, so you don't think it's confusion?
No, a 48.5% split at this kind of volume, it doesn't really indicate a confused market. It indicates a market that's weighing highly credible but diametrically opposed systemic realities. The people deploying six-figure sums on this, they're looking at the exact same on-chain metrics, the same Federal Reserve reports, same network upgrade schedules. They're just weighting the final impact of those things differently.
Right. So let's pull those arguments apart then. Let's start with that 48.5% yes side. The people betting that Ethereum's going to break down to that $1,500 floor.
Yeah.
Because they didn't just pull that apocalyptic number out of thin air, right?
No, definitely not. It's heavily rooted in recent historical trauma.
Yeah, the ghost of 2022. I mean, we only have to look back a couple of years to see Ethereum trading well below that $1,500 mark.
Exactly. That 2022 crash is essentially the baseline for their whole model. The yes camp is looking at the current macro environment and basically saying, hey, we've seen this movie before. We know how it ends.
The gathering of storm clouds.
Right. And the biggest, darkest storm cloud they are modeling is the macro headwind. Specifically, sustained elevated interest rates.
So for you listening who maybe don't watch the Fed every day, the yes side is heavily weighting the pull of risk-free yields. Basically, when central banks keep interest rates high and you can get like 5% just sitting safely in government bonds, well, a highly volatile asset like Ethereum suddenly has a massive burden of proof to justify why a big institution should hold it.
Yeah, capital allocation is a zero-sum game at the end of the day. If the risk-free rate makes traditional fixed income look good, liquidity just drains away from the furthest edges of the risk curve.
And Ethereum is definitely out on that edge.
Oh, firmly out on the edge. Despite its massive market cap, it's still way too risky for most conservative institutional allocators. So the macro argument here is just that traditional monetary policy is going to steamroll any actual tech progress the network makes.
Right, but it's not just the Fed, though. The yes camp is combining that external macro threat with a very real internal threat, like fierce competition from alternative networks. The sources talk a lot about Solana and also Ethereum's own Layer 2 solutions, these L2s.
Yeah, the architectural divergence is the core of their technological bear case.
Let me try an analogy here. If we look at the Ethereum virtual machine, the EVM, it processes things sequentially. It's like an established railway system, right? A train leaves the station, you have to wait for the track to clear before the next one goes.
That's a great way to picture it. It's a structural bottleneck.
Right. But then you have Solana, which uses parallel processing. It's like a brand new multi-lane bullet train network that can handle thousands of passengers all at once without anyone waiting. And they're trying to steal passengers away from Ethereum's older tracks.
Exactly. And the yes camp isn't just saying, well, Solana is faster. They're pointing out that parallel processing fundamentally alters the cost of doing business on-chain.
Yes, it's cheaper.
Way cheaper. If high-frequency trading firms can execute complex trades for fractions of a cent with, like, sub-second finality on Solana, the money is naturally going to migrate there, and developers build where the money sits.
Yeah, user follows developer, developer follows money. But honestly, I would argue the threat from layer 2s, the L2s, is actually more insidious to Ethereum than Solana is.
Oh, that's an interesting take. How so?
Well, L2s, like Arbitrum or Optimism, they were built to scale Ethereum, right? By batching transactions off-chain and then just settling the receipts on the main network. But by doing that, they're basically parasitic. They siphon the user activity and the transaction fees away from the base layer.
Right, you're starving the main chain.
Exactly. If nobody's actually transacting on the base layer because everyone's up on layer 2, the primary way the Ethereum token accrues value is just gone.
It's the grand paradox of Ethereum's whole roadmap. They successfully scaled the network by pushing activity to L2s, but in the process, they decentralized their own fee revenue.
Yeah.
The Yes camp sees a future where L2s capture all the value, leaving Ethereum as just a high-security settlement layer that doesn't generate enough organic demand to sustain a high price.
And then you throw regulatory uncertainty on top of that. Does that regulatory opacity act as, like, the storm that could wash out the tracks entirely?
It absolutely does. The ongoing uncertainty around how digital assets are classified, the threat of aggressive enforcement, it's chilling. We're not talking about retail guys getting blocked. We're talking about compliance departments at multi-billion-dollar funds.
Right, the real money.
Exactly. They look at this and just outright refuse to deploy capital into decentralized finance because the legal framework is completely opaque.
Yeah.
Capital deployment at the institutional level requires legal certainty. If they don't have it, they shelve the project.
Wow. Okay, so when you synthesize all of that, the macro environment draining liquidity, Solana outperforming on throughput, L2's cannibalizing fees, and regulators freezing institutional money, that 48.5% yes position sounds airtight. Honestly, $1,500 almost sounds optimistic when you lay it out like that.
It's a highly rigorous bear case, for sure.
Yeah, but the price hasn't collapsed yet. The order book is completely deadlocked because the no camp is sitting on the other side of this. They believe Ethereum has built this massive structural fortress since 2022. So what is keeping the floor up?
Well, the primary defense they point to is institutional adoption. Specifically, the approval and momentum of spot exchange-traded funds, or ETFs.
The Wall Street money.
Exactly. The ETF wrapper fundamentally changes things. It allows massive pools of capital pension funds, registered investment advisors, to buy the asset through regular financial rails. They don't have to deal with crypto wallets or private keys.
Okay, wait. Let me play devil's advocate here.
Yeah.
Because I think there is a massive contradiction in relying on institutional adoption. Okay, let's hear it. We just established that the biggest threat to Ethereum is the macro environment interest rate hikes, driving traditional capital away from risky assets. But now the no camp is saying the biggest defense is ETFs, which is literally that exact same traditional capital. The Wall Street guys buying the ETF are the exact same people who will aggressively dump it the second the Fed raises rates.
That is, wow. Yeah, that's a phenomenal observation.
Right. The fortress and the storm are controlled by the exact same people. It means ETF momentum isn't a reliable safety net at all. It just turns Ethereum into, like, a high beta NASDAQ tech stock. If the NASDAQ drops, the algorithmic traders are dumping their Ethereum ETFs too.
And that heightened vulnerability is exactly why the no camp doesn't rely solely on the ETF argument. They acknowledge it's a huge distribution channel, but their real conviction is anchored in the internal, hard-coded mechanics of the network itself.
The deflationary shields.
Yes. They argue the true defense against a $1,500 floor is the structural shift in how supply is issued, specifically the concept of the merges deflationary pressure in EIP 15509.
Okay, let's break that down for the listener, because this is where the underlying math becomes the shield. How does this actually work?
So, prior to these upgrades, Ethereum operated on an inflationary model to pay miners. But now, the architecture splits every transaction fee. Part of it goes to the validator, but the base fee, which fluctuates based on network demand, is permanently burned.
Meaning it's mathematically destroyed, removed from the circulating supply forever.
Exactly. So if the base fee is burning supply and the issuance of new tokens is strictly controlled, Ethereum can actually become a deflationary asset when there's sustained network activity.
And the no side points to the baseline volume of decentralized finance, right? DeFi.
Right. Automated market makers, lending protocols, stablecoins, all of these require continuous activity on the base layer. Every state change requires gas. So this baseline DeFi activity creates a perpetual bid for block space.
And as long as that demand exists, the network is literally burning its own supply. A shrinking supply naturally pushes the price floor up. So is this internal deflationary mechanic the only real invisible shield holding up that $1,500 level?
For the no camp, it's certainly the strongest one. It actively restricts the available float.
But wait, the counter to that internal defense brings us right back to the layer 2 argument, doesn't it?
Oh, yep, here we go.
Because that burn mechanism only provides a concrete price floor if there is actual congestion on the base layer. If the layer 2 networks are successful, if they batch thousands of transactions perfectly, they drastically reduce the congestion on layer 1.
Which means the base fee drops.
Exactly. And if the base fee drops because L2s are efficiently absorbing all the activity, the burn rate plummets. The network flips from deflationary back to inflationary, and the supply expands again. So the whole mathematical scarcity defense is entirely contingent on the base layer remaining inefficient and congested.
Which is such a brilliant catch-22, and it perfectly illustrates why these two forces are locked in a 48.5% stalemate. Every single structural advantage has a direct, equally powerful counterweight.
It's a closed-loop system of opposing forces.
Exactly. The deflationary mechanics are offset by layer 2 fee abstraction. The massive ETF liquidity is offset by the vulnerability to macro rate shocks. Institutional interest is countered by regulatory opacity. It's totally gridlocked.
So with everything perfectly balanced, the only force left that can actually resolve this million-dollar tension is time. And this Polymarket bet runs all the way until the end of 2026.
Which, in digital asset years, is a sprawling expanse. 2 years is an eternity.
Oh, easily. We're talking multiple Fed interest rate cycles, probably 2 full generations of new hardware for parallel processing, and entirely new administration's regulatory appointments. Anything could happen.
But the cool thing is, the sources point out that you don't actually have to wait until December 2026 in the dark to see how this plays out. The shifting sentiment is entirely transparent.
Right, you can track it live.
Yeah. Aggregators like PicksByOdds.com allow you to track the exact probabilities of this contract as new information hits the market.
It's basically like watching a scoreboard in a tied championship game. I mean, by watching these odds on PicksByOdds.com, you are essentially looking at a live seismograph of institutional sentiment. Like if an inflation report comes out hotter than expected, you can literally watch the yes odds tick up from 48.5 to 51% in real time.
Exactly. Or if a massive traditional asset manager announces they're launching a new fund on the base layer, you watch the no side absorb that liquidity and push the odds back down. It turns all these abstract, dense market structures into a daily spectator sport.
It strips away all the noise of like crypto Twitter and just focuses entirely on where real capital is willing to take on risk.
And, you know, it's important to emphasize here for our listeners that as we analyze all these mechanics, our role today is strictly observational. We're just unpacking the market's indecision based purely on the sources.
Right. Neither of us is taking a definitive side here on what the outcome will be.
Definitely not. The data just provides a window into the architecture of both the bear and the bull cases. Neither side has a monopoly on certainty right now.
The facts dictate the analysis, and right now the facts dictate a perfect tie. The immovable object of ETF momentum and deflationary mechanics versus the unstoppable force of macro headwinds and Solana competition.
A literal 50-50 deadlock.
But, you know, dissecting this massive standoff leaves me with a final thought that I just can't shake. Something for you listening to mull over on your own.
Let's hear it.
We spend so much time analyzing these incredibly sophisticated quantitative models, the precise tokenomics of EIP 1559, and all these complex macroeconomic yield curves. The participants putting up this $1 million are armed with the most advanced analytical tools in the global financial sector.
Oh, without a doubt, the absolute bleeding edge of market intelligence.
Right. And yet, after processing all of that data, running countless simulations, modeling out network architecture 2 years into the future, the collective conclusion of all that localized brilliance is just 48.5%, a statistical coin flip.
Yeah, it really makes you think.
It forces you to ask the question, if over $1 million of the smartest capital in the ecosystem is completely deadlocked at basically a 50-50 probability, does that imply that forecasting the future of decentralized finance is currently just beyond the scope of any quantitative modeling? Does it mean that all these experts and algorithms, despite all their advantages, ultimately have no more foresight into the realities of 2026 than a completely random roll of the dice.
That is a very sobering thought to leave on.
It really is. Well, that wraps up our deep dive into the Polymarket Ethereum standoff. Thanks for joining us, and keep your eyes on the scoreboard.